Hi, I'm Steve Spencer from SMB Capital, and today's trading lesson is don't chase. And I'm sure there's many of you out there who are familiar with this. It's applicable to traders in all time frames as well as investors. So whether you're trading intraday or you're a swing trader or a longer term investor, this is something that harms your results and also eventually can lead to eliminating you from the game. So couple of points to make right at the start. Sometimes you get away with this. The idea is a stock moves up quite a bit. You hear something, someone talks about it, you see something on TV, and you're not particular about jumping in. You don't really have much of a plan. You just know the stock's gone up a lot, and you jump in there, and it works out, and you make some money, and things seem good. But eventually, everyone gets burned when they try this. And then finally, when you do take losses, when you finally get burned in something like this, when you chase, that one loss, it's going to take you 5 or more really good trades, solid trades, just to get back to flat. And so overall, it's just not worth it. And so what I want to do is I want to take a look at a couple of stocks where we can kind of talk about this concept of chasing and what it looks like. So the first one is Apple. I picked Apple because this is a good example of a stock that after earnings gapped up and spent a couple of weeks moving sideways before it broke out above $120 a share. And I think a lot of people were watching that, and those who got in above 120, 121 were rewarded over the next couple of weeks with a really nice, a big move, a 10% move to the upside. And, getting in above 120, 121, 122, that's where you get in when a stock starts to move higher. When you start getting in at 128, 130, or even on that breakout above 130 and 132, 133, that's kind of where you get in trouble. And especially people who aren't pros, who are just part-time jumping in there. They get in at 132, and then a couple of weeks later they look up, the stock's at 125, 126. What should I do? And before you know it, it's back down at 120. Ultimately, that's where they hit out. And then when it goes to 140, they're like, what happened? So I thought that this was a good recent example. And actually what brought this topic to mind, I actually received a couple of messages on StockTwits and emails in this cyber. And CYBR, this is a stock that I actually got involved in at 53 after it gapped up on earnings. And over the next few days, it traded as high as $70 a share. This is the classic example of a fast-moving momentum stock that when you get involved, after it's run up 4 or 5 days in a row, all of a sudden, a few days later, it's down 20%, and it's, do I hit out here? Do I hit out 30% down, 40? Where do I get out? And so I received a message from somebody who was long, I think from $68 or $69 a share, just to kind of break down for you where I was looking at the stock. First of all, my first alert went off. That large gap there from the low 40s to $50 above 50 was when it reported earnings. So this first came on my radar about 4 days before earnings when it got above $38 a share. So to me, that was the first spot to get involved. And it ran up to the low 40s before earnings. Unless you had some options protection, you're not going to take it into earnings. Then it gapped up above $50 a share. So at this point, it's up 30% from where it was a week before earnings. And I thought as long as it held above 52, it was, there was about $1, $2 defined risk. Maybe it could run up to the 60s. That was a pretty good risk reward. The person who's jumping in on that day 4 after the earnings gap up above 65 into 70, there's virtually no way to control your risk there unless you're sitting in front of your screen. You can see that big down day. What happened was a gap down. I think an analyst said something negative about it. But the real reason it went down was not that analyst said something negative. It's who really, as it starts coming down, is going to be willing to buy this stock at 66, 65, 64 in any meaningful way. And so if more people are jumping out, if the people who bought in front of earnings in the high 30s, low 40s decide, I'm up 40, 50% now, I want to get out. If the people who are buying after the earnings gap at 52, 53, 54 all decide, wow, it's starting to go down, I want to get out, who really is going to be willing to buy this stock before it comes back down into the 50s? And so it's a very precarious thing to start chasing. And so you really want to make sure when a stock starts to break out that number one, you don't chase it 3 or 4 days into the move. Number two, you have a very well-defined exit that justifies the risk that you're taking. If you're jumping into the stock at 65, are you going to hold this to $90? Because if your stop is down at 55 or $50, you better be holding it and be willing to hold it up to the 80s, or else it makes no sense from a risk-reward standpoint. Why do people chase? FOMO, F-O-M-O, is fear of missing out. They know other people were in it. People got it into 40, people got it into 50, and so they just chase and chase and chase. Pros do this as well. Just chatter. You start to hear, as the stock moves up 30, 40, 50%, CNBC talks about it, all the other business channels talk about it, and the chatter, eventually the psychology takes over, the emotions take over, you get involved. And the other one, which I've seen from time to time over the years, is this kind of self-sabotage, which is people know that when they jump in at $70 a share, they're probably going to lose money, but it's almost like they want to get out of the market what they think they deserve, and they kind of think they maybe deserve to lose some money, and so they just jump in. And then finally, momentum, which is, this is a good reason to jump in for a professional trader. When a stock is just moving higher and higher and higher, a professional will jump in because once that momentum stops and the music stops, they'll get out. And so those are some of the more common reasons why people chase. But at the end of the day, again, with the exception of a very few professionals, it's going to come back to bite you in the butt, and you don't want to do it. So the upside is here. These sort of setups, Cyber, Apple, we talk about them every morning in our AM meeting. We talk about what are the good entry prices. That's what we have the written game plan for. These are the prices that are good risk reward. These are the prices when it gets below those where you want to get out. We talk about profit targets, and those written game plans and kind of going through the setups with a professional trader with almost 2 decades of experience, that's going to make sure that you don't chase, that you're actually patient for your prices, and you're going to have a much more confidence in the trades that you get involved in. And so if you just Google SME Trader 90, you can find out more about the morning meeting and all the other tools that we use on our desk, and hopefully this will be a more logical, rational way to approach the markets. Hopefully you learned something today. Thank you.